That way, the extra expense of active management is a huge, mostly deadweight loss to investors. If I asked you to guess how mutual funds perform on average compared to overall stock returns, you probably could make a good guess. Some of you would think, financial markets are pretty darn efficient, and it's hard to pick winners. I'd guess that before fees, mutual funds earn just about the same amount as the overall market. Some of you would come at the problem from a different direction, but you'd get the same answer. You'd think U.S. mutual funds hold around $15 trillion in total assets. That's a big part of the entire U.S. market, so mutual funds can't possibly earn too much more or less than the entire market. And you'll all be right. The gross returns on mutual funds are just about the average return for the entire market. After deducting the costs of operating the funds, mutual funds have no free lunch either, they fall a little short of the overall market. If you compare the performance of the average actively managed mutual fund against an index fund designed to track the overall market from 1970 through 2008, you'll find that the active fund wins maybe 15 times and the index fund wins a few more than 20 times, with the rest too close to worry about. Professor John Cochrane of the University of Chicago isn't surprised that we continue to see mediocre results from actively managed funds. A small number of managers might be really good. They're the Picassos of the investing industry. But the average artist isn't all that good, is he? Why should it be different for money managers? What we really want to know is how to identify those outstanding managers and get in on the deal. And that's a problem. Professor Malkiel has shown that there is very little consistency in terms of which managers achieve superior results in any given period. The guy that beat the market by a lot this year probably didn't beat it by a lot last year, and the odds are good that he won't beat it by very much next year either. In fact, according to most research, whatever consistency we find across time is that funds with high fees generate fairly persistent bad results. Nobody seems to be able to pick enough winners over even just a few years to overcome high fees. If that's the case, though, then how can all of those brokerage firms and mutual funds advertise that they outperform the market? They can do this for the same reason that every single car company can claim to be the best. Nissan might claim to have the most horsepower. Toyota might counter with the best customer satisfaction. Honda chimes in with, what? Maybe it has the best resale value. Perhaps Ford touts best-in-class fuel economy. Funds do the same thing. Every active fund can find a time period when it beat some index, and that's what you're going to be hearing from them. You can probably tell that I'm a big fan of mutual funds, especially index funds. Toward the end of the 20th century, an upstart started to crowd into the mutual funds territory. The Toronto Stock Exchange, or the TSE for short, gave birth to this new kid in March of 1990. Named the Toronto Index Participation Fund, and usually called the TIP 35 or just TIPS, this exchange-traded fund, or ETF, let investors like us buy a single security that tracked the TSE 35 composite index. Like an index mutual fund, this ETF was designed to match the returns of the index. But unlike a mutual fund, you bought and sold the ETF on an exchange, just like an ordinary stock. That's why it's called an exchange-traded fund. The first U.S.-traded ETF was the Standard & Poor's 500 Depositary Receipt. These SPDRs, pronounced spiders of course, appeared in 1993. Asia came on board in 1999 with the Hong Kong Tracker Fund, and Europe's Eurostoxx 50 market ETF appeared in 2001. ETF growth has been phenomenal. According to the Investment Company Institute and Investment Fund Trade Group, ETF assets grew from just a few $1 billion in 1998